A jeweler in Mumbai received a shipment invoice last week that made her gasp. The silver she'd ordered, the same silver she'd been buying for 15 years, was priced at $98 per ounce. Not the spot price you see on financial websites, not the paper price traded on exchanges, the actual physical deliverable silver she needed to run her business. She called 3 other suppliers thinking it was a mistake. They quoted her $102, $105, and one supplier simply laughed and said he had no silver to sell at any price. While the world watches, spot prices hover around $30 on their screens. Something extraordinary is happening in the real economy. Physical silver, the actual metal you can hold, has quietly reached $100 in certain markets, and almost nobody in the mainstream financial world is talking about it. This isn't a glitch. This isn't temporary. This is the beginning of the greatest wealth transfer in precious metals history. And it is happening right now under the radar while investors stare at manipulated paper prices thinking they understand the market. The divergence between what silver costs on a screen and what silver costs in your hand has become so extreme that it means breaking the entire pricing mechanism. And when this breaks completely, the explosion in official prices will be so violent that it will rewrite every investment textbook. I hope you're doing well. If you like my video, please subscribe to my channel and hit the bell icon for more video notifications, because what I am about to share with you is not speculation or theory. This is happening right now in real time, and understanding it could be the difference between massive wealth creation and watching the opportunity pass you by. Let's be clear about what we're discussing. The spot price of silver, the number you see on financial websites and news tickers, represents paper silver traded on exchanges like the COMEX. This is a derivatives market where hundreds of times more silver trades on paper than actually exists in physical form. Futures contracts, options, ETFs that claim silver backing, all of this creates price discovery in a theoretical world, disconnected from physical reality. But when you actually try to buy physical silver in meaningful quantities, you enter a completely different market. Premiums, the amount you pay above spot price, have exploded to levels never seen before. In some markets, these premiums are $50, $60, $70 or more per ounce. Add that to a $30 spot price, and suddenly you're paying $100 for silver. This isn't happening in one location. This is happening globally, from Asia to Europe to North America. Coin dealers are facing unprecedented demand they cannot fulfill. The US Mint has been rationing silver eagles for months. Wait times for physical delivery have stretched from days to weeks to months. Large institutional buyers trying to take delivery of silver from the COMEX are being offered cash settlements instead of metal. Think about what that means. You have a contract that legally entitles you to physical silver. The exchange says they'd rather pay you money than give you the metal. Why? Because the metal isn't there. The registered inventory, the silver actually available for delivery, has been drained to critically low levels, while open interest. The number of contracts claiming that silver remains enormous. This is a powder keg. When the market realizes that paper claims vastly exceed physical metal, the scramble for real silver will send prices into the stratosphere. The industrial sector is already living in a $100 silver world. Manufacturing companies that need silver for electronics, solar panels, medical devices, and electrical components are paying whatever it takes to secure supply. They're signing long-term contracts at prices double or triple the spot price because production cannot stop. A solar panel manufacturer cannot tell customers they can't deliver because silver is unavailable. An electronics company cannot halt assembly lines worth millions in lost revenue daily because they can't source silver. These companies are price takers, not price makers. They pay what's demanded, and what's being demanded is approaching or exceeding $100 per ounce in real transaction prices that never get reported in mainstream financial media. Let me explain why this divergence has developed and why it's accelerating. Silver is the most manipulated market on Earth, and that's not conspiracy theory, that's documented fact. Major banks have been fined hundreds of millions of dollars for silver market manipulation. Traders have gone to prison for spoofing silver prices. The manipulation happens through massive short positions in the paper market that suppress prices regardless of physical supply and demand fundamentals. This worked for decades because most investors were content to own paper silver, never demanding physical delivery. But something has changed. Investors are waking up. They're demanding physical metal. They're removing silver from the system, storing it privately, taking it out of circulation. As physical silver disappears into private hands, the disconnect between paper prices and physical prices widens into a chasm. Consider the economics from a dealer's perspective. Wholesalers are paying massive premiums to secure inventory. They're competing with industrial users, with mints, with other dealers, all chasing limited physical supply. By the time silver reaches a retail customer, the all-in cost reflects these realities. A dealer might pay $45 per ounce wholesale, add their margin, shipping, insurance, and suddenly retail price is $70, $80, $90 or more. The spot price becomes irrelevant. It's a number on a screen that has nothing to do with actual transactions in the physical market. This is how you get $100 silver in practice, while spot prices remain suppressed. The situation in Asia tells you everything you need to know about where this is heading. In countries like India, China, and Singapore, physical silver premiums have been astronomical for months. Cultural affinity for precious metals means Asian buyers understand real value versus paper promises. They're buying physical metal aggressively, paying premiums that would shock Western investors. Chinese buyers are particularly aggressive, and China has shifted from a major silver exporter to a massive importer. When the manufacturing powerhouse of the world starts hoarding a metal instead of exporting it, that's a signal. They see what's coming. They understand that silver is both money and strategic industrial resource, and they're accumulating while Western investors remain distracted by stocks and cryptocurrencies. The supply crisis underpinning these price moves is structural and worsening. Global silver production is essentially flat. New mine discoveries are rare. Existing mines are aging. Meanwhile, demand is exploding across every category. Electric vehicles require up to 1 kilogram of silver each, and EV production is ramping up globally. Solar panel installations are breaking records every quarter, and each panel requires silver for conductivity. 5G infrastructure build-out demands massive silver consumption. Medical applications are expanding. Electronics demand grows with every new device and system. You have surging demand meeting stagnant supply, and the deficit is being filled by draining above-ground stockpiles that are finite and depleting rapidly. Government stockpiles that once contained billions of ounces are gone. The U.S. strategic silver reserve is depleted. China has been accumulating, not selling. The silver that once provided a buffer against supply shortages no longer exists. This means every ounce of deficit must come from private holdings, from investors liquidating positions, from scrap recycling. But as prices rise, investors become less willing to sell. They understand scarcity. They see the trend. They hold, waiting for higher prices. This creates a vicious cycle where rising prices reduce available supply, which drives prices higher, which further reduces willingness to sell. Here's what's truly terrifying for anyone short silver or relying on paper promises. The total above-ground investment in silver in the world, all the bars and coins held by investors, amounts to roughly 2 to 3 billion ounces. That sounds like a lot until you realize that represents about $150 billion at current suppressed prices. Global wealth is measured in hundreds of trillions. If even half of 1% of global wealth tried to move into physical silver, the market would be completely overwhelmed. There isn't enough silver to satisfy that demand at anywhere near current prices. Prices would have to rise to levels that seem absurd today, not just $100, but $200, $300, even higher until demand is destroyed or new supply incentivized. The mining stocks are telling you something important. Silver mining companies have seen their stock prices multiply even as spot silver prices remain relatively tame. Why? Because informed investors understand that these companies will benefit enormously from the coming price explosion. A company mining silver at $25, cost and selling at $100 real price has massive margins. As this reality becomes reflected in official prices, not just physical premiums, mining stocks will go parabolic. This is why smart money has been accumulating mining shares while retail investors chase technology stocks. Central bank policies guarantee the situation gets worse, not better. Money printing continues despite inflation rhetoric. Debt levels globally are unpayable and growing. Every currency is being debased simultaneously in a race to the bottom. In this environment, hard assets with genuine scarcity become incredibly valuable. Silver is the most undervalued hard asset on Earth. It's monetary metal like gold, but with added industrial necessity that creates non-discretionary demand. You can choose not to buy gold. Industries cannot choose to stop buying silver. This combination of monetary properties and industrial necessity, coupled with extreme scarcity, creates a perfect storm for price appreciation. The energy transition alone requires silver at scales that are difficult to comprehend. Every government on Earth has committed to reducing carbon emissions. Solar power is the cornerstone of those plans. Current solar installations use approximately 100 million ounces of silver annually. That number is projected to potentially triple by 2030 as installation rates accelerate. Where will that silver come from? Total global production is roughly 800 million ounces annually, and 70% of that comes as a byproduct of other mining that won't increase just because silver prices rise. The math doesn't work. Supply cannot meet demand at current prices. Prices must rise until solar companies either find substitutes, which they've tried and failed to do, or until some demand is destroyed, which won't happen because it's mandated by policy. The paper market manipulation is in its final stage. Suppressing prices works only as long as people accept paper claims as equivalent to physical metal. That acceptance is evaporating. More investors every day are demanding physical delivery, removing metal from the system, exposing the fraud of fractional reserve precious metals. When confidence breaks, when enough people simultaneously demand their metal, the entire paper market collapses. Short positions that have suppressed prices for years will need to be covered. Covering requires buying actual silver, but the silver doesn't exist to cover these positions. This forces either default, which destroys confidence in the entire commodities market structure, or emergency buying at any price, which sends silver vertical. Jewelry markets, industrial users, investors, and governments are all competing for the same limited silver supply. This is unprecedented. Historically, these groups didn't compete directly. Jewelry could wait for lower prices. Investors could be satisfied with paper. Industries had reliable supply chains. Now everyone needs physical metal simultaneously, and nobody wants to wait. The jeweler in Mumbai cannot wait for lower prices that may never come. The solar company cannot delay installations. The investor has learned that paper promises are worthless. The Chinese government isn't waiting for bargains. They're all bidding against each other, and the result is $100 silver in real transaction prices, even if exchanges report $30. The coming official price recognition will be spectacular. Eventually, spot prices must reflect physical reality. They cannot diverge forever. When COMEX prices start reflecting actual physical premium, when exchanges are forced to acknowledge real market prices, the adjustment will be violent. We're talking about potential gaps of $50, $60, $70 overnight as the paper market capitulates. Investors who waited for spot prices to reflect reality before buying will be left behind. The smart money is buying physical now, paying the premiums, securing the metal, because they understand that $100 silver today will look cheap when official prices hit $200, $300, or higher. Historical parallels are instructive. In 1980, silver briefly touched $50 per ounce, equivalent to over $150 in today's currency when adjusted for inflation. That move was driven primarily by investment demand from the Hunt brothers and inflation fears. Today, we have investment demand plus industrial necessity, plus structural supply deficits, plus currency debasement, plus geopolitical tensions. The drivers are more numerous and more powerful than 1980, yet prices are a fraction of inflation-adjusted historical highs. The reversion to historical norms alone suggests massive upside, and that's before considering the new industrial demand paradigm that didn't exist in 1980. The $100 silver that has quietly reached the world isn't a headline. It's not on the evening news. It's not being discussed by mainstream financial analysts who remain fixated on paper prices and traditional metrics. But it's real. It's happening in wholesale markets and private transactions, in industries that need metal to function. The divergence between paper and physical has reached a breaking point, and when it breaks completely, when official prices are forced to acknowledge physical reality, the wealth transfer will be stunning. Those who positioned themselves early, who understood that real silver commands real prices regardless of what manipulated exchanges report, will profit enormously. Those who trusted paper prices and delayed action will watch the opportunity evaporate. $100 silver isn't coming. It's already here for those operating in the physical world. The only question is how long before everyone else realizes it.